So one of the, SOXY, SOXY outperformed. One of the reasons that SOXY outperformed, and this is an important thing to think about. I mean, I know you do think about it, and I have, in this conversation and others I've had with you, I know that you make sector bets. That you believe that certain segments of the economy and certain baskets of stocks are likely to outperform the market more generally. And so you focus more of your capital investing in those spaces. SOXY is a thematic that is focusing on semis. And therefore, if that sector outperforms, you will outperform. And it has outperformed for that exact reason. I think it is fair to say that some investors might be less comfortable than you are making those kinds of thematic decisions, and they probably need to focus more on it. I know it's less appealing to say, okay, I've got a fund over here, it's done 23% over the last 12 months, and I got another one over here that did 15% over the last 12 months. The 15% is good for you. And everyone's going to say, no, that's 23, 24%. That's good for me. But the problem is, if I'm going to direct somebody and say, you're going to invest your future, what do you want to have in your investments? Just if you don't have any view, and if you're going to set and forget, it kind of has to be diversified, and you're not making those kinds of individual bets, because maybe these people buy a fund and then they go on a 4-month trip someplace, or maybe they just dollar cost average into things and simply neither know nor want to know what it is they're investing in, because they don't want to have the burden of trying to decide that, I think now is the best time to be in energy stocks. Now's the best time for me to be in semis. Now's the best time for me to be in staples. You make those determinations, but for the people who don't, they probably should be in something that's just sort of more broad market diversified. That's my guess.
And that's exactly where I actually go. My majority core is in the Qs.
Mm-hmm.
Right. So I own a lot of the NASDAQ. I do own some SPY funds as an index, and then I do the whole satellite, right? GPTY, Chippy, right? I do satellite funds, and they're very much a whole lot smaller holdings. Right?
What's interesting about your decision to do that is that this is a point I make. Generally I tell people, for your equity allocation, if you bought something like an S&P proxy, that's fine, right? So just look for, it could be a Vanguard fund, it could be a this or that. For your equity exposure, I think that's fine. I also do believe, though, that people should take an active role in their own futures and their own investing. And I actually encourage, when people are stock selecting, I talk about this. I do these sort of open mic sessions on YouTube periodically where people can just ask me questions. But I make a common point about this, which is that if you're going to buy stocks, and whether you're investing in a sector the way you are, or whether you're picking individual stocks, one of the things you can do is use the broad market as your own personal hurdle. In other words, I can look at the S&P and I can tell you that the S&P's revenue growth exceeds GDP growth pretty consistently. So if U.S. GDP growth is 3%, the S&P's top line revenue growth is closer to 5 or 6% historically, with some setbacks, of course. GFC, I mean, we have bear markets and we have economic conditions that are weaker. And earnings growth is even faster than that. So I think, the 10, 15-year CAGR for adjusted net income growth for the S&P 500 constituents is close to 8% or even slightly higher than that. So what I tell people is, if you're going to do like what you're doing, which is pick a sector, or if you even want to go and start picking individual stocks because you think you might be able to identify opportunities that could potentially outperform, use those as your hurdle. Don't look at stocks or sectors that are growing more slowly than the broad market index, because now you're taking individual stock selection risk on something that isn't growing as fast as a diversified basket of stocks that will outperform the economy overall. Why would you do that? So when you pick SOXY, it makes perfect sense, because you're saying this is the hot spot right now. This, as a group of stocks, these are going to outperform. Fundamentally, they're going to have faster revenue growth, faster earnings growth, and very likely, as long as the market is doing well, bigger price appreciation for stocks. So, and you can cull the list of investable securities significantly just by exercising simple disciplines like that.
That's right. When I read Jay's book, Buy and Hedge, 10% should be on intuition, what you think might outperform. Everything else have more of an index look. I choose the Qs as my hurdle, right? You can use SPY as your hurdle. And you have, like I said, there's funds out there that's actually beating the Qs. And I'm sitting there going, why would I not own those funds compared to just having, you know, SPY or SPY or, I mean, I keep on hearing from particular financial people that income investing is terrible and it's going to destroy your long-term wealth. I mean, I've literally seen this on a YouTube video, and he's no names mentioned. And I'm sitting there going, but I'm beating the Qs. I don't understand. I'm beating the Qs. I'm beating the SPY, and you want me to hold SPY and some bonds?
Ooh, yeah. So that's an interesting, that I'm not so crazy about. So this is kind of an interesting thing, and there are some rules of thumb that used to be true, and I'm not convinced that I'm not sure that those old rules of thumb stand so well. So people used to talk a lot about things like a 60-40 approach. You've probably heard some people say, oh, well, if you're an individual investor, you should have 100 minus your age allocated as a percentage to equities, and the rest should be some kind of a fixed income investment. I think it's really important for people to understand that what seems like a time-tested strategy is tested over a period of time that had a very strong secular dynamic to it. And actually, I can just pull up a chart, and this will illustrate this as about as clearly as one can. And that is that if you were invested in an equity and bond portfolio over the course of, let's say, the last 40 years, so we'll go back to, what is that, 1985? This chart is a chart of the U.S. 10-year Treasury rate over the last 40 years. And you're going to notice something that is pretty clear, and that is that we were in a prolonged bull market for bonds. Okay? So this strategy, people will say, well, it worked great. Well, yeah, it worked great. Because if you own bonds and interest rates drop, what happens to bond prices? They move in the inverse direction. So if you bought bonds at any point from 1982 or so on, you're making money. You're making money in capital appreciation, and you're making money in income. And by the end of it, almost none of that came from income, because as you can see, well, maybe you can't see it right here, but I'm just going to tell you what this line is. Right there, the 10-year rate was 0.5%. Now, what kind of an investment is that? I mean, I won't use any profanity, but it's crap. Okay?
Yeah.
You cannot put your money into a 10-year lockup at 0.5% in a 3 to 4% real inflation rate environment for a decade and think you're going to have anything but losses. It does not work. Full stop. If you had bought high quality investment grade with, call it 150 or even 200 basis point spread over this, you still are a dead bang loser. If you had a portfolio of long dated mortgage debt, and by the way, in a continuously, the big risk for some of these assets in the declining rate environment was exactly the opposite risk that you have it when you break that long-term trend. And I don't think I just drew that line, But I think we can definitively say that that downtrend line is well and fully broken. I'm going to make a trend line here, but that's it. I mean, you could draw the trend lines any way you want. ZERP is over. Okay? That's not coming back. Now, if you were investing in mortgage bonds, one of the risks that people had was prepayment risk. What's that? That is when you buy a pool of assets and the borrowers say, hey, I have a 5.5% mortgage rate, and I can refinance that at 3.5%. I think that's a good idea, and that's what I'm going to do. So you pay back your mortgage early, and then you take out a new mortgage at 3.5%. So the prepayment risk is the idea that I buy a pool of interest-bearing instruments, and then as rates go lower, some of that gets prepaid, so I don't get the interest rate I thought I was going to all along the way. So you depend a lot on this capital appreciation element. Now what happens if you bought that pool of assets when the mortgage rates were 2%? If you bought a basket of 2% mortgage rates bonds, how many of those are getting prepaid now? You desperately want them to be paid back, but they're not going to be, because nobody who has any sense at all, who has an $800,000 mortgage that it is got 25 years left and is paying 2%, are they going to prepay that thing? Not a chance. They're locked in their houses. So the 60-40 allocation worked well because of this dynamic, but you cannot expect it to work indefinitely if this dynamic doesn't persist. And we know that it couldn't. Rates were not going to go to, look where rates were at the beginning of this picture, 10%. They went to 0. For this to continue to work, they would have to go from 0 to -10 over the next 40 years. That's just dumb.
And when I hear stuff like that from people, I still use something close to a 60-40. I try to use a 60-40 rule.
Yeah.
60% in equities. Now there's gold funds out there that can make me 12%, 13%. There's preferred stocks that make me over 9%. Right? That takes a little bit off of, there's still equity, but it's preferred stocks. Right? So there's other brands of other things that you can actually own. I have a very small portion in credit. So there's other assets out there that you can own.
It's interesting because I don't know what kind of credit you own, but if you have like relatively low duration, like Trip B, something like that, you can get very decent rates of return. Maybe you're getting 6-7%. You don't have a lot of duration risk. So if rates rise, that's not a problem.
I'm closer to 11. I'm closer. FSCO.
So you're a little okay. So you are, let's say, a little for if. I don't know what kind of credit you're investing in. Those are fairly high rates of return. So maybe you're taking a little bit more risk there. But yeah, I mean, look, you don't want to take a whole lot of duration risk. But I will say, I want to add one other thing. This is just a generic comment I'm going to make. And I've been wrong about things in my investment career as well. But my gut is telling me we are not going to go back, even if we have a set of dynamics that would otherwise encourage rates to return to the kinds of things that we saw in the late 70s and early 80s. Really high inflation rates. We got high inflation rates in 21, 22, and parts of 23. It didn't really start to stabilize until 24. If we get inflation rates like that and they persist, free-floating interest rates should exceed the rate of inflation. Real rate of interest should be higher than rate of inflation, which only makes sense. People don't want to hand over $100 worth of value only to get 90 of it back. So the thing is, though, that we can't actually go back to rates that high, because if we did, it would bankrupt the government. We have too much debt. We have too much deficit. We have too much that is maturing. It can't happen. So we actually can't do what happened then. You can't have a Paul Volcker come in and say, okay, we're going to have double-digit risk-free rates. So I will say that while I think that there is still risk of potentially rising rates, we actually have seen a lot. It's interesting. The short end of the curve has come down over the course of the last year. The long end of the curve has actually gone up. It's gone up quite a bit, actually. So that dynamic is telling us something. But I do think that at some point, policymakers are going to have to, and I don't know how they go about doing this. Do they aggressively use the Fed's balance sheet, for example, to cap rates at the long end because they recognize that the economic risks of allowing rates to explode and all of federal revenues go to make interest payments is unsustainable? Is that one possibility? I suppose. Is there some form of restructuring that takes place? That seems like that would have hugely, angst-causing effects. If you went and told people, well, these treasuries that we said we're going to pay X are going to pay X minus some number, but you got to do something. You can't have rates go to 10%. So I will say that at least for that portion, I don't think that you're going to get as much risk. There's also, the higher rates go, the less convexity there is in bonds. So if you look at TLT, for example, which is the long-dated Treasury ETF, and you take a look at what happened between 2021, when we had basically no rates, and late 22, TLT dropped 50%. That's supposed to be a risk-free asset, folks. U.S. Treasuries down 50%. So much for risk-free. So I do think that people need to have income-producing assets. I would not be putting my money into long-dated treasuries to accomplish that, I can assure you, because I don't know that we're going to get inflation comfortably below 2, and certainly not real inflation comfortably below 2. I think the real rate of inflation is always higher than the headline figure. But I also think that we're not going to go back to double-digit longer-dated treasuries because that's not sustainable. Like the math don't math.
Okay. So, let's ask a couple questions, and this is going to be back on ULTY. Mm-hmm. I listened to a conversation about options strategies changing slightly. Mm-hmm. Can you speak about that and what you're trying to do that with the option strategies?
Well, the option strategies aren't changing that much, but there are some things that maybe folks will not have seen, and this is partially a function of the constituent changes. Let's see if we can come up with a concrete example. I'm going to see what's in there as of, typo, that didn't work.
I understood it was going to be some put spreads, with with
a little bit of a kicker in here. So let's just take a look at what's going on I'm going to put, I'm hoping this is going to filter so I can have a concrete example. Oh, good. Worked. Okay. All right. So let's just take a look at NVIDIA. We have NVIDIA in here. This is not a stock I need to tell anybody about. I think everybody watching knows what NVIDIA is. So we have a core position in NVIDIA. You can see 400,000 shares of it. It's 5% allocation. One of the other things you can see is that we are short some calls. In this case, it's next week's 190 calls. We're short 4,000. So that's just basically a covered call on NVIDIA. So far, so good, right? You will also observe that we have some long puts and we have some short puts, right? So in this case, there's actually a put fly. 180, 170, 160 put fly. So in the event that NVIDIA falls down to 170, that is actually affording some protection. But that protection essentially wears off at about 160. Now, in this particular case, we're looking at the options that expire today. So these are almost, these will have been adjusted by this time. But basically, there was insurance in the event that, where is NVIDIA right now? It was like 182 the last I saw. Hopefully a little bit higher. I think the market was doing right. Let's see where we're at. 182.70. Okay. So 160, we have some disaster protection in the form of a decline to 170 versus 182 over the course of just a day. So that's a 6.5% decline, would actually pay the fund money. But that insurance essentially wears out because of the ratio in the event that NVIDIA should fall all the way to 160. But 160 for NVIDIA in a post-earnings environment would be a decline of 12.5% in 2 days after earnings had already come out. What do we think the chances of that happening are? Pretty slim, right? And in any case, you are also collecting premium on the short call. So the performance of this portfolio of instruments on NVIDIA specifically will still outperform NVIDIA in a down move by a modest amount. I mean, a really modest amount, because remember that the general structure of ULTY is to be net short premium, because income is important. Options income is important. If income is important, you can't be net long premium. You have to be net short premium. So the creativity that's being deployed here is to still have some measure of protection, to still have some measure of outperformance in the event that the underlying equity declines, to have a little bit of upside participation in the event that the stock appreciates. And we saw that, it was the 190 calls, I think we were short, right? So you have $10 worth of potential upside appreciation and a little bit of a tailwind of positive carry, the theta. And these positions will get adjusted or rolled, and potentially rolled aggressively in the event that the underlying equity moves so that that balance stops working in your favor. If the underlying equity drops so that the puts that you own have more premium than the calls you are short, you kind of need to adjust that, because otherwise time's not on your side anymore, and the tailwind becomes a headwind. So these strategy adjustments, we did an X Spaces on Wednesday, and somebody was asking me about this issue specifically. And I'm, when I bring up something like theta, theta is like one of the simplest concepts in options that there are. It's one of the primary Greeks. What are the primary Greeks? Theta, gamma, delta, vega, and less important in our context, rho. And why is rho unimportant? Because it's a carry cost issue, and we trade mostly short-dated options here, so that doesn't play very much into it. Actually, vega doesn't play that much into it either, again, because the options are short-dated. But for us, theta is really important. Delta and theta are the two things that matter most. ULTY's stocks are going to be net long on balance. If the stocks go up, the fund will benefit and the shareholders will benefit. We are net long delta in those stocks. And we are net long theta. That means that time is working on our side. We're collecting options premium. But because we have some long and short options, as the price of the underlying asset moves around, that theta can go from positive to negative. When it becomes negative, you have to adjust. And that was the only point I was trying to make on that Spaces, and it's the point that I'm trying to make now. This is not in options world, there's a lot of fairly complex topics. This isn't one of them. This is kind of options 101 stuff. I'm not telling you anything and you and your audience don't know, but just so that people say, well, why did they adjust this or why did they adjust that intraday? You go to the office and you knew what the positions were the preceding night, and then you come in and you're waiting for that update and you say, hey, they adjusted these positions, or you look at the trade file and you say, look what they did. You'll be able to figure it out if you look at the intraday price chart, because you can say, oh, I see what happened. The stock fell. So those puts now were worth more than the calls they were short. So, of course, they had to adjust the calls and they had to adjust the puts just to monetize some of the hedge and to make sure that you have time working on your side. That's, a key objective. It was always that part in ULTY hasn't changed.
So let's talk about what's important to Brad. Does this affect Chippy and GPTY?
No, it doesn't. The stock selection process in Chippy and GPTY is determined by a different set of criteria, mostly thematic, right? So, for example, if I buy a semiconductor index, there isn't really a whole, you're not going to suddenly see Costco in there, right? That has nothing to do with it. ULTY, the stock selection process in ULTY, the reason that this is in such sharp focus and sharp relief is because it doesn't have those restrictions on it. People expect for thematic funds, you're not screening for stocks, and you're not screening for non-correlated assets. You're not screening for non-correlated assets in a semiconductor fund because it's a semiconductor fund. They are correlated. That's part of what you bought, and it's part of what you expect. I think it is one of those things that people were getting in ULTY but didn't know why outperformance happened when it did, or why underperformance happened when it did. And now, from our perspective, we're saying, okay, implied volatility is not going to be the, not only the principal screening, but the largest and most important screening by a large margin. We want to make sure that we don't have these sort of conditional correlation issues, and that's going to cause some non-correlated assets. Thematic funds are naturally correlated, and they should be, because otherwise you're not going to benefit. If you buy semis and you say, hey, all the semis are up, but my SOXY didn't go up, and we're like, well, that's because we got some gold in there. You would say, that is not what I signed up for. So
Exactly.
I think, I think you should remain confident that the objective of each and every one of these funds is to do what is on the tin. And to the extent that it is necessary to change what's on the tin to articulate a strategy chain, that will also take place. So if you have to put a sticker on the prospectus to say, we didn't mention this, but we're imposing something because we have tested this approach and we recognize that it's going to improve the results going forward, that will show up in the prospectus as well. So, if you're wondering what you're getting, that's the best place to look.
So, rumor, it's not a rumor. I've seen the prospectus. Reverse splits.
Mm-hmm.
You're going to do them.
Mm-hmm.
I personally will tell people, calm down. There's other funds that have done this recently this year, and the distributions went up. So why is everybody so afraid?
I think I know the reason people are afraid, and that is because I think people conflate reverse splits in high distribution ETFs with reverse splits in single stocks. So let's talk about that for a bit. Why do single stocks typically reverse split? They reverse split because usually the stock price has declined precipitously and the shares are at risk of delisting. And so they have to reverse split as an exchange rule. Now, that is not the reason why these are going to reverse split, but there are considerations for investors that they should think about. And there are interim considerations. But the short one is that there are people who use options on these funds to trade their strategies. And if you have a $5 stock and you have 50-cent strike increments on the underlying fund, that means that the strikes are 10% of the underlying away from one another. That's not sufficient granularity to use these options effectively to work your strategy. So a higher stock price benefits you. There are other ways that higher stock prices benefit you. House brokerage requirements may or may not have arbitrary thresholds that are dictated by the share price of the underlying fund or stock that you hold. And so they might impose maintenance requirements or restrict your access to margin if that's what you choose to use. So you don't want that to happen either. Now, for the same reasons that investors can be concerned about a reverse split in the common, there are rules that the house brokers might impose in the short term until they can establish that suitable liquidity exists in the underlying shares and say, all right, we're not going to extend the margin to the high price shares post-split, post-reverse split. So a $5 becomes a 20 or a 50 or whatever the reverse post-reverse split price is, until we've managed to establish that there's suitable liquidity in the underlying and that things are behaving the way that it should, and then everything should normalize. Now, from an investor's point of view, once that's done, you're in a better position than you were to begin with. But the other question funds holders, I think, have is, does this change the percentage that I can expect to receive in income and distributions from my fund shares? So if I had 1,000 shares and now I've got 100 shares, does that mean that I'm going to expect to get a lower distribution rate? And the answer is that the fund itself, the fund managers, when they're affecting these, they have no visibility on the number of shares. They're imposing their strategy on the fund, and that's going to have certain return characteristics. And then distributions are made pro rata back to the shares, right? So it doesn't matter to them how many shares is divided into. It could be 1 or a billion. The rate will remain the same. So the rate relative to the pool of assets does not change. It's just how many shares is divided into. So if I have 100 shares where once I had 1,000, then I'm going to get essentially 10 times as much per share as I would have received if there had never been a reverse split. However, and I think this is also important, if you're looking at ULTY in particular, so in Misty's case, is the only thing about Misty, if there's a reverse split, is that there's just going to be a smaller share count, and each share is going to be worth more, and each distribution is going to be higher. In ULTY's case, you have two moving pieces going on at once. One is related to the stock selection process. And as I previously articulated, you now have non-correlated or less correlated assets in there like GDX and GLD, but they might also be slightly lower implied vol. So the amount of premium you're getting from those, well, let's take a look. I mean, I can actually just see what GDX is right now. It's not low vol compared to like the S&P or something like that. I mean, GDX is 44 vol. You can see it right here. So we're selling options premiums in GDX right here. From a historical context, I'd say, no, that's not bad, right?
I think one of the problems that people have, and this is actually not even your fault, is if volatility goes down right after a reverse split, they're going to see the distributions go down.
Yeah. So well, that's the point that I really want to make, is that if someone's looking at ULTY and they're saying, hey, my distribution rate is changing for this reason or that reason, we call that in the investment business performance attribution. In this case, it's going to be distribution attribution. Where are my distributions coming from? Are they coming as a percentage of my investment as a function of the share count? They are absolutely not. But they can rise and fall for other reasons. To your point, if implied volatility falls generally, that means that the amount that we are collecting by selling options is also going down generally. And if the constituents of ULTY include some stocks that don't have as high implied volatility as they did previously, Costco is in the fund. Costco does not have the same implied volatility as Palantir. That's just a fact. Neither does Alphabet. Neither does Meta. Neither does NVIDIA. And all of those are in that fund right now. Now, that doesn't mean that these aren't attractive implied volatilities. I think that they are reasonably attractive, actually. So let's take a look here at NVIDIA, for example. NVIDIA's implied volatility, even net of the news going out 1 month, is almost 50. Well, that's quite good. We can see that on a historical basis, right? So for most of the past 12 months, it's been lower than that number. And in many instances when it was higher because a news event was upcoming. In this case, the news event is already behind us. So if you can sell 50 vol and the news is already out, this is good. We like that. But it's not Palantir. Palantir, the implied volatility is typically going to be very high. 60 is what you've got in Palantir. And it's not as high as it was, but it's still high. So those options are going to be extremely juicy. But we see that there's another problem, and I'm going to show that problem right here by imposing the recent share price on this. And so we can see the stock was 207, and where are we now? It's 160. So that's a pretty steep decline. And, it's the interplay of these two things that generate total returns for shareholders. Are the underpinning shares at least remaining stable and hopefully appreciating? And are we able to collect a good implied volatility in the options that we sell against them? And in the case of some of these stocks, and you're going to see there's more of a rebalancing going on, the trade-off is being made to say, we're going to take a lower number on this white line, the implied volatility, for a portion of the portfolio in exchange for lower volatility in this portion of the portfolio, which is the share price. In this case, this sucker is down $50. It was a $200 stock. It's lost 25% of its value since the beginning of this month. And that's the balance that you're trying to accept. Now, this works okay if I had two stocks that were completely anti-correlated, that were very high vol. That would be all right, because I'd have one stock that was down 25%, maybe the other one's up by a like amount. But if you have a basket of stocks that when one goes, they all tend to sort of go down like dominoes because they're all high beta, high flying. Imagine meme stocks. Like if you had like a meme ETF and I had only GameStop and AMC and stocks like that in it, it would not surprise me that if the bloom came off of that rose, that the correlations between them would rise, and that presents risks to shareholders. And so that's being mitigated a little bit. And I think on balance, this is going to be positive. The other thing I would say is that if we get into a higher volatility environment in the general case, so let's say that we've been in a prolonged bull market, and that's been great for investors. That doesn't last through 2026. How do you capitalize on that if you're going to be short vol? Do you want to have stocks that are going to be highly correlated, or are you willing to say, you know what, the general level of implied volatility is going to probably go up a bit? And we saw that in the stocks I just showed. It's true in Nvidia. It's true in Meta. It's true in a lot of these. Some of these were very low volatility, and now they're starting to creep up. So I think in these cases, when people see names that maybe they didn't traditionally think of as the place to harvest short premium, they're going to start looking at these and saying, actually, they're more appealing now than they were. And if stocks dip a little bit more and you get a more compelling entry point, that'll be even more true, because you get to buy the stocks a little bit cheaper, volatility is a little higher, your expected returns over the ensuing 30 days are probably also going to go up with that.
So let's talk about your new 25% payers. You got a bunch of new ones coming out. Why in the community, don't want to say this is Brad's only opinion, but the community as a whole, why now? You already have like NVIDIA that's done okay, but most people are upset because the price has gone down over time, where NVIDIA has gone up in price over time. Now you come out with a 25% payer. Are we going to have the same kind of problems? Why now? What's going on? What's the
well, let's take a look at Nvidia. So Nvidia is up 23.4% total return year to date on a reinvested basis, and 13.27% if you had just simply taken the distributions in cash and put them into your 3.8% money market account, right? Now, if you take the dividends reinvested and you add that to the price change, that's effectively the amount of money that has come back to shareholders over this period of time. So what we're looking at is about, if you had invested $100 at the end of the last year, like the last trading day of 2024, about $50 has come back to you in the form of distributions. And you would have about $64 still remaining. Okay, does that make sort of sense in your shares?
It does.
And depending on how the return of capital numbers pan out, one hopes that the return of capital numbers for the fund are high. It would be perfect if they were 100%, right? Because then you have no tax consequence on the distributions, and then basically any potential tax on the 13% gains that you've experienced over the last year are going to be in the form of a capital gain if and when you sell the shares. So one of the things that I would say about the target 25s is that because they are targeting distribution, and we can do that math, right? So if I've distributed 50% of the initial share price, which I have, right? So $100 in at the end of the year, you've gotten $49.75 back in the form of distributions. Well, in a target 25, I would at this point have been distributing about half that amount, actually slightly less by this time, right? Which means that a larger percentage of the fund assets would have been allocated to try to capture some form of capital appreciation rather than maximizing the distribution, the payout amount. And actually, one of the ways that you can see this is you can say, well, if we look at something like SOXY, which I know you're invested in, take a look at what you have over that same period of time. Well, what you end up seeing is, and I'm actually going to go to the same date just so we're like, okay. So here, what do you have? You have total returns reinvested of 26.74%, 25% if you just took your distributions and put them into cash, and 13.5% of that came in the form of capital appreciation. So when you take, and this is on a diversified, well, not a diversified, but on a thematic basket of stocks. And so if you're doing it on single stocks, one of the things you're going to see is that you can probably have a higher target rate payout than you can on something like Biggie, which is a diversified basket, because the implied volatilities you're capturing are going to be slightly higher. So the work we've done suggests that you're going to be able to give very handsome distributions in those stocks, but get more capital appreciation. And I would make one other point, which is one of the critical things, certainly in maximizing capital appreciation relative to distributions, is that you need to be able to hang on to the underlying asset for as long as you can so that you don't realize a gain. Because realizing gains and generating that form of especially short-term capital gains is something that you have to pass back, or else you encounter, a negative tax consequence. So that has to be baked into the strategy ahead of time, right? Because so by doing this, you're going to say, okay, we're going to just sell premium that's a little further out of the money. We're going to try to hang on to our core holdings just a little bit longer and just get a little bit more capital appreciation through time. The way to think about it is, if there are funds that YieldMax has that focus on maximizing distributions from whatever source they come, and you have ones that are target 12s, and you say, well, in this particular case, maybe I would like bigger distributions than we're currently seeing in SOXY. On a single stock basis, this makes sense. I think on SOXY, is a great product because it is a diversified basket. But let's just say, for the sake of argument, that I had a single stock that performed like this. Maybe I want a slightly bigger distribution and some capital appreciation participation. The target 25s are going to make some sense because it's one of those things, people talk about YieldMax funds as if they're a monolith. They'll say, well, look at Misty, Misty is down, strategy is down. And look at Winter, it's up. It has nothing to do with YieldMax, what strategy's stock has done, or Tesla has done, because we have Tesla and we have Crash. So the real thing is how the strategies themselves perform, and then striking the balance. People say, well, I want more capital appreciation. We have ones that do that. You guys aren't buying them for whatever reason. Don't tell me that's what you want and then not buy the funds that do it.
Hey,
I don't know what to tell you.
Somebody bought it, right? Somebody
did. You bought it. You bought it, and you're smiling. That's why you're so smiley. You're going into Christmas saying, "Yeah, I bought this thing." You get to hold your hand up, but not everybody does. Look, if we all had a crystal ball and knew how things were going to turn out, would we have made different investments? Of course, the short answer is, of course we would. But I think the reason that I think target 25s are likely to be appealing is because I think only now do people who have had the experience of either owning target 12s or owning something that has very high distributions but has a declining share price say, I'm actually looking for some balance of these two. I am actually looking to have, more consistent share price, and I'm willing to trade off some of the distribution to do that. And, I remember after I left the first options trading firm that I worked for and went to the second, that the principal of that firm, who had previously been one of the first employees at Susquehanna Investment Group and had run derivatives at Morgan Stanley, he asked me, he said, how did you learn to trade options? The answer is by doing it. How do you learn to trade and invest in income distributing ETFs? You learn by doing it, how they behave, what they do, and the parts that are important to you and what you want to prioritize. And you don't know right off the bat what you want, because you don't even get to see how they act and perform. The people who bought ULTY on its first day probably had a sense of what was going on, but maybe now that it has a little bit of a history and a track record, or Misty or NVIDIA or any of these, they are smarter investors today than they were. And they are now better able to make an informed judgment about the balance of capital appreciation and distribution that they're looking to strike. And in order to accomplish what they want, we have to have something that sort of fills that whole gamut. The SOXY fund, it's 50-50 basically. It's more capital appreciation than it is distributions at this point, from the end of last year to the present day, because it's a target 12, right? If it was a target 25, and let's assume that the numbers were exactly the same, it was the exact same pool of assets, you would still have capital appreciation, but you'd have bigger distributions. And so that's the purpose of these products, is so that people can choose from them. And there's a lot to choose from. There's 60, and there's going to be more. If we include the European ones, I'm not even sure exactly how many there are, because I think 2 of those came out this week. But this just gives people the flexibility to choose the funds that essentially strike that balance. Is capital appreciation what you want? Is distributions what you want? Somewhere in the middle. There's something for everybody.
Or are you going to change the strategy? Are you going to do? Everybody keeps on talking about.
Is the target 25 slightly different strategy? It is, because you're choosing a different strike, right? So in order to get more capital appreciation, you have to sell strikes that are a little bit further away. But that's why the target 25 is in there, because one of the things that happens is that the amount that you can distribute and the amount that you anticipate to collect from the short option is going to be slightly less, but you get more participation to the upside. That's, again, it goes to the squeezing the balloon thing. How much participation do you want in capital appreciation of the underlying asset versus how much extrinsic premium are you trying to get from selling the options? It's one thing that's kind of, I think, a good analogous way to think of this is that we're a little bit in the insurance business, right? And if you are an insurance company, you sell different forms of insurance some have higher deductibles and some have lower deductibles, right? So if I have a very high deductible, I charge a lower insurance premium for that. But I also don't take the immediate risk. Somebody, if they have a high deductible on their comprehensive and somebody breaks the side window of your car, that might be inside the deductible. I as the insurer, don't have to pay for that. And that's essentially what these different products are, is that you're kind of setting the deductible in different places. They're different policy types is one way to think about it. And I think if people understood that, then they would realize the respective benefits. SOXY and Biggie are insurance plans that have relatively high deductibles. And ULTY and NVIDIA and Misty have very low deductibles. And the target 25s are going to be somewhere in the middle. So somewhere between, I have on my own car insurance policies, for example, I have very big deductible. But I think I run like a $2,500 deductible, because if something happens to one of my cars and it's $2,500, I'll pay it. And unfortunately for me, I got teenagers. So there's a good chance that when one of those cars goes to the high school parking lot, it's not going to come back the way it went in. And I'm okay with that. And if it needs to be touched up, I will pay to do it.
Anything else you want to talk about in conclusion?
There's always so many good things to talk to you about, Brad, because we could probably, you and I could probably chit chat until next Monday if we wanted, if I could stay awake and if you could. I don't know that anybody can stay awake that long if I'm doing all the talking, but
we both have that same issue, by the way.
Yeah, look, I guess the important thing to say here is that, with respect to the target 25s, it splits the difference between the target 12s and the max distributing strategies that are already out there. So for people who are wondering why you would do it, it's because there's a balance to be struck between them. For those who are wondering about the construction of the underpinning ULTY portfolio, the ULTY portfolio was, and it was actually their principal focus initially, to focus on just looking at high volatility stocks and constructing a portfolio of them. And they did that, and at times that did exceptionally well. But one of the downsides of it that we saw is that high volatility stocks tend to be high beta. High beta tends to be risk on mentality. Risk on mentality converge or correlation rises when you get into a risk off mentality. And the Bitcoin basically rollover that we experienced beginning in October created that. We saw a lot of risk off, and we saw correlations rise in that space. And so the portfolio is going to have a little bit less of that. Trying to fault anybody who is making decisions on stock picking before then, because they were following their mandate. But the mandate did have aspects that it is very clear, I think, investors were not that pleased that there was a big basket of stocks, and that when things rolled over, those went down too. So you reduce the volatility of the constituent portfolio. That has carry-on effects, but hopefully the stability that comes from the underpinning assets is something that investors will appreciate. I hope that they do.
Well, thank you for coming on the channel. And everybody that likes this type of content, hit the like and subscribe so you can get more of it.